Good afternoon, Peter Klein, Chief Investment Officer, co-founder, Align Wealth, with you this afternoon, the 27th of January, and wanted just to sort of craft where we're at, where we're thinking about markets and the economy and the importance of those data points as it relates to the work that we're doing for our clients every day. So with that, allow me to share the screen and we'll get started. Okay, so I wanted to start with this quote because I believe that now with the current sentiment in the markets, I think this is more important than ever. The less prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own affairs. That's Buffett. I think it's important that we understand that. And this next slide, the duality of our mission, right? We're not investors that just sort of sit up in an ivory tower and make buys and sells all day long and basically not communicate with their clients. We are wealth managers. We have a dual mission, not only to grow the assets under our stewardship, but also to ensure that our clients understand what we're doing, that we communicate with them, that we are mindful of the protection of that capital. That's the other side of this balancing act. That's the other side of our dual mission, understanding the importance of capital protection, ensuring a long-term retirement and a legacy going forward. It's very important. We're balancers and we're balancing both. And it can get dicey sometimes when markets just roar higher and we're sitting here saying, time to be careful, time to be thoughtful. Let's not just jump in the deep end. Lest you think we don't have a defined process, I know you know we do. It starts with understanding our clients and then moving into asset allocation work, and then of course we spend a lot of time in the area of macroeconomic and market portfolio management, developing different portfolios and different models, monitoring that, and of course, reporting that to our clients and how it impacts their legacies, how it impacts their cash flow and their financial plan. Okay, just a couple of slides about through Wall Street. Okay, first one, inflation's vanquished. I don't believe so. I'm an unabashed inflationist at this current juncture, and I don't think that inflation is vanquished. I think it takes a lot more to get that genie back in the bottle, right? And I think oftentimes it's a recession or a nasty market crack of some sort that brings inflation down. I don't hope for that, clearly, but I don't think inflation is yet put back in that bottle. And to that end, I find it very difficult for any Fed official to lower interest rates in face of what very well might be continued sticky inflation readings. So we'll see. This slide shows you how much of the CPI basket is above 3%. And so it's telling. And again, the CPI is not the best thermometer for this. There are others that we use and the Fed uses, but the entire takeaway is inflation is still, let's call it sticky. And to that end, if it stays sticky or gets stickier, we very well may be in a non-interest rate cut mode, despite the politics behind the latter. But it doesn't mean that it has to happen, and that would be a bit of a surprise to the folks on the bulls on Wall Street. And of course, we always talk about valuations. We talk about valuations because it's been shown in study after study going back 100 years that it is the best factor to determine the long-term, I use the word long-term, market cycle, the long-term impact on success of investment. It's an important factor, not in the short term. In the short term, anything could happen. Momentum, noise, a lot of things come into play. But in the longer term where we live, right, as wealth managers, as that duality of mission, we have to look at this and we see valuations as a critical input to determining the long-term potential growth of one's portfolio. Essentially, if you pay up when going in, you're going to have a tougher time over the span of time. However, if you buy low, the upside is much more significant. This chart shows you at a host of different metrics how we are now at all-time highs, going back to 1901. So, we are in rarefied air, to put it lightly. Here again, more statistics. the CAPE index from Robert Shiller of Yale, Nobel laureate. We are the second highest priced on a CAPE basis. CAPE is the cyclically adjusted PE ratio, which he smooths out the earnings over 10 years to give you a better sense of the earnings net of the business cycle, so to speak. And again, second time all-time highs, right? And then this one is the favorite one of Warren Buffett, where we compare the GDP and the market cap. And again, all-time highs here. Now, some folks will say to you, some of these companies, they deserve to be valued so highly multiple-wise, and because their earnings and their cash flow. And I get that. These are great companies, there's no doubt. I just don't want to, I want to be able to buy them when they're on sale. I mean, that's what a good fiduciary does, right? Why chase the hot dot when you could be patient and wait for the fat pitch? But oftentimes we're looking at earnings that underpin market cap. And when you see earnings get disassociated, when there's a gap between the market cap, as you see in this chart, between the market cap and the earnings for that same index, it means the market cap's ahead of itself. And while that can persist, as it has, it often doesn't over a long period of time. Concentration, look at what we're seeing here. 10 largest stocks in the S&P 500 command a 40% weight. The tech sector commands a 34% weight. As of 500 stocks in the index, 10 of which is equal to 40%. Folks, the S&P 500 is not a diversified index. So if you're a diversified investor, that's not your bogey. You're never going to win. You have to think about that because it's important. The other takeaway that I thought was interesting from this chart was the defensive sector. Think pharmaceuticals, healthcare, consumer durables. These have come down, and therefore I would argue are cheap. Here's what's not cheap. Popping is this price to sales ratio at 10x for 30% of the S&P. 30% of the S&P is trading at 10 times sales. That's off the charts. That gives me pause. To sales, that's not to earnings. All right, we always want to know, that's where the puck has been, and we want to know where the puck is going. So let me just show you a couple of slides about our friend AI, right? So AI has been the big driver of the markets. What if it disappoints? What if we get some news this week on earnings that suggests that the big Mag 7 stocks are not going to spend as much or just slightly less? This is going to become a big surprise to Wall Street. So we have to think about that. It's gone up so much. The spending has been so strong that we have to think about the what ifs. Moreover, I speak about the productivity gains from AI. This is a transformative technology, no doubt about it, will change the world. But is it likely to change it over the next 6 to 12 months? Or over the next 6 to 12 years. And so I think this is where we have to sort of understand what's happening today. A lot of the excitement is being pulled forward, as it always happens with new technology on Wall Street. Everyone gets excited, everyone bids up the stocks, that bid up price, those prices going up, brings more buyers in, and you see what happens. It gets inflated. The question, of course, is what has AI done for me lately? And if it's simply just giving me a better email or reading through a report and giving me a summary, all nice. Is it really a productivity gain? To some extent, perhaps, but maybe not to the point of where the valuations are. So that's what we're trying to look at here. There's been a lot of talk about the productivity growth expectations, not to mention also the risks from loose regulations on AI as well. There's a big article out on that as well. One of my big concerns on AI is obsolescence risk. Lest you think otherwise, there's a lot of other people in this world that are very smart STEM mathematicians and technologists that are working on the next iteration of AI, the next big chip or application. And there's lots of them in India and China especially. And I wonder and I worry that there very well might be something that coming down the pike that dislodges the United States as a leader in this field. Always looking for opportunities. I will just mention cash as first, not really an opportunity per se, but we do think overweighting cash makes some sense in a given circumstance. Buffett's Berkshire Hathaway, although it's not Buffett's anymore, I guess, Abel's running it now, near 30% in cash. That's telling you something. Valuation metrics. Here we have a deep value over growth. That's an opportunity in our book. Healthcare, as I mentioned before, healthcare and life sciences are trading at discounted levels. We think that that's an opportunity, especially given their durable cash flows. And here's another chart that speaks to the same issue with healthcare. You see how the absolute PE ratio is down here, and how the market cap, the valuation rather, has come down considerably. It's a margin of safety. Doesn't mean it goes straight up from here. It'll be moving around a bit, but it's certainly an opportunity at these levels, it would seem to us. As are small and mid caps trading cheaply for the last few years. I think we're going to beginning to see an outperformance here. So I like mid cap stocks. So that is where we will leave it. I want to thank you for your attention and your continued vote of confidence in Align Wealth. Please remember who we are, what we do, our duality of mission, our focus on proactive empathy and fiduciary-centric advice. This is what we do. We do it all day long. We've been doing it for decades. If you have any questions, feel free to reach out. Have a great day.